Hi Phil, how are you?
Hi, how you doing, Renee?
Good. So today we're here with Philip Palumbo, who is the founder, CEO, and Chief Investment Officer of Palumbo Wealth Management. Welcome.
Thank you for having me.
Absolutely. So obviously there's a lot of talk out there today about markets, finances, what do we do with our money, and that's exactly what you help people do, right? So I think one question that's on everyone's mind is there's all this talk about recession, but yet the markets are doing great. So can you explain that phenomenon?
So there's a lot of moving parts to this, right? The way I like to say it, it's kind of a slow bleed that eventually will bleed out, and it just hasn't happened yet. And so the reason why markets are up year to date, call it 8-9% in terms of the S&P 500,
Which is great, yeah.
Which is great, and the Nasdaq's up around 20%, is mainly on the back of the Fed pausing or even decreasing rates by the end of the year. So remember, markets get ahead of this, right? So markets always look forward about 6 months or 9 months. So that's what they're anticipating. So markets are trading up based on that information.
Anticipation, right.
That's number one. And number two, remember, inflation now is decelerating, right? So it's not accelerating. Anytime inflation accelerates, it's very bad for stocks.
Right.
And bonds specifically. You know, bonds and stocks last year really performed poorly together.
Right.
So you have that really dynamic that shifted as well. So I think for those reasons, and really the most important reasons of them all, is this artificial intelligence talk. So the chatter around AI has been tremendous for tech stocks, right? So the only reason why the S&P 500 is up 9% is because of really 4 to 5 tech stocks. If you take those 4 to 5 tech stocks out of there,
pulling up the market.
it's pulling up the market overall. If you take them out of there, the market's actually flat to negative year to
That's
date.
interesting.
It's very interesting. So the breadth of the overall market is actually not that great, and you know, so you can almost be fooled by the market performing well year to date.
Can I just ask, do you know what those 4 or 5 companies are? I'm sure.
Yeah, so NVIDIA, Apple, Amazon, Google,
Got it.
right, and Facebook, really, or Meta rather, are the
Right.
5 real businesses that have performed very, very well year
Right,
to
but
date.
if you take them out, obviously it's a different
It's a totally
viewpoint.
different ballgame.
Yeah. Okay. So, you know, do you believe that a new bull market has begun since the market bottomed out in October of last year?
Yeah, so a couple of things. Going back to recession talk, right? So the tricky thing about recession talk is, and I said this many, many times, over the past couple of years, 3 years really, all with the pandemic and all the money that was put in people's pockets, right? That provided a cushion for a lot of people. And when people have a cushion,
It's a fake environment.
it's a completely fake environment. So between that and between the Inflation Act bill that was passed, which is additional stimulus that goes into the economy, right? That kind of created this cushion where even though the Fed is hiking rates so aggressively in any other environment,
it's bizarre. People just don't understand it.
it's completely bizarre, because any other environment that the Fed has risen rates as quickly as he's risen rates, we would have been in a complete crash environment. But what's held things up is this idea of this cushion of money that's been put into the economy, and consumers have money to spend. On top of that, the jobs, right? The jobs numbers are very, very good. So the job market is very tight. And the reason why the job market is tight is because employers, it took a lot to hire the right people after the pandemic.
Right.
And now that because it's very hard to find skilled workers. They don't want to let them go. So they're trying to hold on to them as much as possible. But you're starting to see in the tech industry, financial industry, they're starting to lay off.
That's right.
And many other companies are actually freezing right now. So, and typically there's a lag anyway with unemployment. The unemployment rate typically starts to rise after the Fed is done hiking. So we're pretty much almost at that point right now. So I wouldn't be surprised in the next 6 months
it's going to bust.
we'll really start to see things happen. So the problem with the whole bust idea is, and this is a positive regarding the bull market. So to answer your question directly, are we in a bull market?
Right.
And the market bottomed in October, which was the most recent bottom that we've seen.
Right.
And since then, it's been up nicely from that point. So the question is, are we in a bull market? There are a couple of positives. The number one thing is sentiment is so negative. Many people, like you just said, and others out there, continue to say, oh, the market's going to crash.
It's something.
The economy's going to crash.
Yeah.
So when people say that, you know, typically it doesn't happen. There are
Oh,
too many people on that side of the trade that are suggesting, even people that don't even know anything about markets or the economy, suggesting that things are going to crash. So that's one positive, and markets always climb. We call this wall of worry, right? So there's a lot to worry about. When there's a lot to worry about, the markets actually still continue to climb. So I'm not saying that things aren't going to crash. I'm not saying that we're not going to have this economic recession, right? I'm not suggesting that. But there are some things that are pointing to, hey, maybe we are in this bull market that started in October, and this artificial intelligence that we're starting to see is going to be the hype that's going to push us to maybe next level.
Even if the stimulus gets withdrawn.
Well, the stimulus that's getting withdrawn right now
going.
is really interest rates going up, right? So that's not directly stimulus, but that is taking money out of the system in a sense, right? And also the Fed is also instituting what's called quantitative tightening. So during the COVID situation, the Fed was actually buying bonds every single month. When the Fed's out there buying bonds, he's creating what's called liquidity into the economy.
Mm-hmm.
The Fed is doing the opposite now because their balance sheet got so large, they have to bring that balance sheet down, and they do that by actually letting bonds roll off their balance sheet every single month. It's called quantitative tightening. So we've got two types of tightening that's going on within the economy that's creating this kind of more illiquid type of economy. So, and on top of that, obviously, so I would suggest that the notion, and I've said that the Fed was going to execute a crash landing, and I've been very consistently saying that. And I would suggest that I was right about that from a standpoint that the weekend that Silicon Valley Bank basically went bankrupt, and then Signature Bank and First Republic. If the government never stepped in and said I was going to back all deposits, on that Monday it would have been worse than the 1987 crash. So the only thing that saved us was, again, this Fed coming in and saving the world, and that's exactly what happened that day. So, and that's almost like we call the Fed put. The Fed comes in and protects the markets, and that's what happened then. And since then,
it's not such a crash landing.
It hasn't been such a crash landing just because of that. Now the question is, and I talked about this 3 weeks ago on my Palumbo Pulse, is that it's a punch in the face that you don't see that knocks you down. So what is it that's out there that we're not seeing besides what we saw, which we didn't see with Silicon Valley, that could possibly be a threat? So my bottom line point is this, right? Is you have to be actively defensive, right? So being defensive in this environment to me makes sense, but you got to be active because there are pockets of opportunity where you can make money.
So that's what I was just going to ask you. The average investor, they come to you and they say, "What do we do? Where do we put our money?"
Yeah. Well, so first what I always like to understand is what is it you're trying to do with your money? Everybody's always saying to themselves, "Oh, what's the best place to put my money today?" And they're looking over the next 3 and 6 months, right? And Treasury bills, I would say, is the best answer to that, right? Treasury bills are paying between 4 and 5%, and so people look at it like, "Wow, I'm getting 5% over a 6 month period. That's an annualized number. It's not really 5%. So it's 2.5 for that 6 month period."
Yeah.
So people feel really good about that, but the reality is that you have to ask yourself, well, what is it that I need to do with this tranche of money? If it's money that I do not need for 10, 15, 20 years, then you should be looking at real estate. You should be looking at stocks of great businesses that are trading below intrinsic value. You should be looking at private equity. Those are the 3 particular areas that over time has produced the best results in terms of growth of wealth. It's indisputable, right? So, and today with rates up, values of real estate properties down slightly or even more in the commercial space, well, now you may be able to find cap rates that are attractive. So there are always opportunities to make money, and it's just our job, right, to go out there and actively do that and have that long-term time horizon.
Right. Is there anything you're telling investors to avoid? Like, definitely don't do X.
Yeah, so right now technology continues to be overvalued, measured by the forward multiple of these companies and where they're trading at, measured by any type of valuation metric. They're way overvalued. And I am a big believer it's the price you pay for something that makes the difference. Makes a difference in terms of how you're going to grow your money over time. So investing in Nvidia today, investing in Apple today, I would suggest is not a good investment because the price you pay today, I don't think you're going to get the return you've seen the past 10 years over the next 10 years. So a lot of this stuff is overhyped because of AI. It's like the .com era, right? So anything that had .com next to it, any company that was .com, it did very well for that 1 or 2 year period, and all of a sudden crashed and bankrupt, and most companies failed, and there were just a couple that didn't fail.
Right. And the last question I have, because I could talk for hours about this, I love this stuff. How should people think about their money? In your mind, obviously you have to educate people. They come to you, and we will provide your information at the end of this video. People can contact you, sign up for your newsletter, which I love.
Yeah,
I look forward to getting it. It's just chock full of really in-depth analysis. And then obviously people can consult with you privately if they would like. So one last question of how should people think about their money?
Yes, this is really important. So I completed my book, which will be coming out in about a month and a half. And the whole idea is about this whole notion of retirement, which is to me a very archaic word, should be changed to what I call work optional. So when it comes to people's money, they should be thinking more about how can I get to a place as quickly as possible where I have complete freedom to do whatever I want.
That's right. It's all about freedom, choices.
Right?
Yep.
So that's work optional. So if you're in a career and you're an employee and you don't really like your boss, you don't really love what you're doing, but you're not able to just leave that particular career, you got to ask yourself, well, what do I need to do to get to a point where I can just do whatever I want? If I want to continue to do what I'm doing, I'll do it.
Right.
If I want to try something different, or if I want to completely stop working, I'll be able to do that. So the first thing you got to ask yourself is, when can I get to the point where I can make work optional for myself? That's question number one. Which really relates to question number two, is really what's the vision for your life for the rest of your life? What does that really look like? Right. And what that vision is for you, what does that actually cost you, your lifestyle cost per year? So what is your number per month?
What do you want to do? How much you need? Yeah.
You need 20,000. So what you're basically doing is you're backing into how much assets you need to have saved that will generate enough cash flow to support your lifestyle.
Right.
Now, when I say assets, it doesn't just mean stocks and 401ks and IRAs.
Right.
It means it could be real estate.
Right.
It also can be a business.
Right.
Right. That's generating cash flow.
Right.
And then it could be money that's saved up. So once you understand kind of where you're going, right? So you start with the end in mind. Then you can say to yourself, okay, here's how much extra money I have to save every year. Here's the return that I need to earn to be able to get to work optional. And then you say, okay, what asset classes can help me achieve that rate of return, right? So let's say you need 10%. Well, stocks and real estate and private equity historically have returned over the past 100 years north of 10%, 10% plus. Well, that's probably a good place to invest. But the most important thing people really have to assess is how much risk you could really handle. Right? So if you're going to go into stocks as an example, if you can't handle the risk, you're wasting your time. So your emotions are extremely important to understand how much appetite you have for risk. So you have to put that all together. Once you do, you have a really well-rounded plan that will help you grow your wealth to get you to the point where work is optional.
So that's why people need to come meet with you, sit with you, and help them figure out their lives financially and elsewhere. Okay, we don't have a lot of time, so I thank you.
My pleasure. Thank you.
And we'll provide everyone your information, and
great.
Keep up the great work.
Thank you, Renee. I appreciate it. Thanks for coming in today.
Okay.